Hi everyone, so today we'll do a stock analysis on the Goodyear Tire and Rubber Company, ticker GT, and these develop, manufacture, distribute and sell tires and related products and services worldwide. Quick disclaimer, I'm not a financial advisor, this is my own research, up to you to make your own decision. So first of all, we're going to talk about the company profile. So get a description of the company, showing the brands, showing as well the clients, this like sales distribution worldwide, and then as well talk about the debt, because that's the major thing for this company. Then we're going to do a fundamental analysis, the usual, showing the numbers and then the charts, and finally going with the insider ownership. Then we're going to go with the technical analysis. So for these videos will be weekly and monthly, price catalyst, and then the conclusion. So let's start with the company profile. So Goodyear Tire and Rubber Company is actually a US company that is subsidiaries, develops, manufacture, distributes and sell tires and related products and services worldwide. It's got like it's pretty much offer tires to automobiles, trucks, buses, aircraft, motorcycles, earth-moving, mining equipment, farm implements, industrial equipment, and other applications. So it's pretty much anything that moves, it's got a tire for it. I mean, generic. So it's quite diversified, which is good. So now let's talk about what the service and products the company provides. So they do retread on trucks, aviation, and off-the-road tires. So what is that? So it's like a tire retreading is the process of like replacing worn out tire tread on a used tire casing with a new layer of rubber. So as you can see, the worn out tire, you remove the part that is damaged or used, and then you add a new layer on top, and you kind of have a new tire. So they do as well manufacture and sell those tread rubber. They sell chemical products, provide automotive and commercial repair services as well. So they have 800 retail outlets, so the shop where you go change your tires and potentially even repair your car, service your car, all these things. So they have this kind of service. They have a website as well where they provide service. So it's the same service. So you can kind of order and say, okay, I want new tires and I want a service for my car, and then go and then directly get that service booked earlier. And then all sort of online kind of like service they offer. And yeah, it seems to be repetition more or less. And the company was incorporated in 1898 and headquarters in Ohio, so in US. So 1898 is like quite a old company. I quite like that part. So now I just want to do a quick comparing two brands that I would say are pretty good. So one is like the Goodyear that we are looking at, and the other is the Michelin tire. So Michelin is, to me, from what I understand, one of the best tire overall. So I thought it would be good to compare those two. So I would say the major advantage of the Michelin is more that it's like pretty good in innovation, longer tread life, and consistent performance. Especially with luxury vehicle overall, and it excel in wet braking and environment sustainability. So in my opinion, from experience, I feel like the Michelin tires are pretty high quality, especially on the day-to-day drive. So I would say just like you drive to work, come back, like very basic things about like with your car. I'm not sure about like trucks and any other stuff, but I know they are fairly good for especially daily use. And the Goodyear, so what it says in there is that it's pretty much great for versatility, durability, excellent all-weather performance, especially in utility vehicle and rougher conditions. So it can offer superior comfort, noise reduction, and sometimes longer lifespan on specific models. So overall, I would say like it's actually very good tire off-road. Anything with like more like a four-wheel drive kind of experience where you can drive anywhere. So that is what I understand the major difference. And it just depends on like the best choice depend basically on what kind of drive you do, like if you do off-road or just basic like going shopping. So that's the whole idea I understood from it. So I'm not an expert in tires obviously, but just wanted to share my experiences as well, a bit more about what they are. So let's talk about all the assets. So what brands do they own? So the global is Goodyear, Cooper, Dunlop. So apparently they're selling Dunlop. So we talk about it later. Then there is the brands in Americas. So I'm guessing all the North America and South America. So Kelly, Mastercraft, Roadmaster, Mickey Thompson, Starfire. Honestly, never heard of those. And then in Europe, Middle East, and Africa, Avon, Devika, Fulda, Sava. I never heard of those either. And Remington brands and various house brands, as well as under the private label brand. So yeah, all that I'm not too aware, but it gives you an idea of all the brands they have. So now let's talk about the clients. So let's start with the company sells to independent dealers, regional distributors, retail outlets, and retailers. So now let's see where they sell the most services and product. So it's in Americas with 56%. Then EMEA, so that includes Europe, Arabs country, and Africa. And then after 14% in Asia Pacific. So as you can see, most of the sales are in America. I mean, if you lose the America clients, definitely it will create a problem for the company. Just to give you an idea. It makes sense because it's actually a US company. So as we will see later, the major problem with this company is the debt. But I wanted to explain a little bit of the basic kind of company situation at the moment before we go really into the fundamental analysis. So their goal is to reduce the debt by selling assets. So yes, it's not ideal. I don't think it's the best way, to be honest, but it seems like they don't really have a choice. We're gonna see later why. So they want to sell Dunlop brand, and they're planning to complete the process basically in mid 2025, so approximately now. And then it seems like the agreement will take 3 to 5 years and will bring around 700 million of cash to the company. So I will explain after the debt and everything. So let's get there. So what they're showing in their cash flow and balance sheet is that they have a total debt of now less than 8 billion, 7.8. And so what I figured, I wanted to know what was the interest expense in 2024, and was 522 millions. So I wanted to get an idea on how much interest they're paying now, and it's 6.4%. Honestly, would say it's not like huge, but I think it will definitely help them if they could reduce their debt, because like when you look at how much their earnings, if they could make an extra 500 million with a market cap of 2.5 billion, it will make a huge difference for sure. So that's where we are at. So their net debt is still at 7 billion. So they have some cash to cover. So let's say they might have a bit more and maybe a little less interest. I don't know. But let's say it's around that 6.4%. So here are the debt maturities. So when would they have to pay it back? So 2026 is 500 million. 2027 is 1 billion. 28, I don't know if these are actually accumulated or not, but it gets higher and higher as we go towards the years. So that means they can't really go bankrupt now, but it could become a problem in a year or two if they don't repay that debt. So for this year, what they have to figure out in here is that how to repay at least their 778 millions for the due within 1 year, the debt due and lease due within a year. And they have that amount in cash, or at least they are safe for a year, let's say, like that. So again, 7 billion of net debt. So now let's talk about the fundamental analysis. So we're gonna show the basic numbers now. So the market cap is 2.5 billion. The P is around 5 at the moment. The price to sale is at 0.14, price to book at 0.4 something, enterprise value at 0.5, and then like enterprise value to EBITDA as 5. So it's overall pretty undervalued company. There is no denying. I mean, it kind of explain why, because of that debt problem. So we're gonna see, so profitability and all that is nothing crazy good, to be honest. So the revenue is 18 billion, and they still have a net income at 400 million recently. And so they have 700 million in cash, like we said, and nearly 9 billion in debt. So I think it's reduced a bit since then, but we might see that updated later because it's a financial year of late 2024 for the whole year. And yeah, overall, I mean, like insider 5%, so it's actually not that bad. And institution have the rest. Basically, no retail investors are even touching this, which I kind of understand in a way. And then like the short is around 7%, and yeah, that's about it, honestly. So in here, so looking at my fundamental side of it, the chart, you can just see in that thing in here how little liquidity there is and how much debt there is. So it just shows, confirm that they have way too much debt. And in the balance sheet overview is not even getting any better, to be honest. The debt has reduced slightly in here, but the equity hasn't even increased. It's very not that great overall, I'll be honest. Like doesn't excite me that much, so I wouldn't put like a huge part of my portfolio in it, that's for sure. Then the current assets and liabilities are again all right. They're safe enough, but ideally the current asset needs to be twice as high as the current liabilities, which we're far from. We are, I feel like, in survival mode right now when I look at it this way. And yeah, I mean, that one balance sheet overview is the same, like way too much debt. Cash is reasonable, but yeah, like an equity is way lower. You would want the other way around, where the net total debt is reduced and then the equity is increased. That's when the company would be way more, like, I would say, growing or getting higher prices. So considering there are retails, total revenue on net income, I usually tend to see not that much revenue on net income compared to revenues, which is exactly what's going on here. I mean, 21 wasn't that bad, but still very low compared to the sales. And then like all the other year have been pretty much similar or worse. Then we have earning per share, which is kind of went down in 2024, but I was up before in 2021 and 2. And then the cash flow is struggling as well, and capital expenditure increasing. And then like, yeah, the shares hasn't moved, or not that bad at least, because they could be devaluing even more, and at least they are not. So in terms of insider trading, insider ownership at 4.3%, like we said earlier. So I've shown all the list of all the executive officer in here, and then showing in there who has bought and who actually has sold. So the people that bought are the CEO and then the president in Europe, Middle East, and Africa. And then the ones that actually sold are this guy. Honestly, it's kind of a mixed situation. So two have bought more share, and then one got rid of all his shares. I don't know if he left or if he's about to leave, but he's got no share anymore. And overall, yeah, I wouldn't say it's a terrible news because some are buying, at least not everyone is selling. But it's little bonus, little bonus. So in terms of technical analysis on the 1 month, the stock went nowhere in 50 years. I mean, this is not that great, I cannot deny. So the thing that I like though is more like it's a cyclical stock. So let's say for options or for short-term trade, I don't think it's that bad, because like usually the price goes between something like maybe $5 and $10-11, which is here. So when you are around that price, it tends to like kind of not stay that long. So here again, here again, here again, here again. As you can see, it doesn't really last that long. So we are back to that range, and my take is more like this is kind of a short term, where if it goes to, let's say, $15-20, I would definitely sell. I'm not really planning on staying in it, because like unless they have a massive change in management, they sell all their debt and then they keep growing, I would prefer not to stay too long in it. But it shows the idea, like every stock has different strategies, and in this one I would say it's better to just buy and then don't expect like more than double or triple, because after that you're taking more risk, where the price kind of never been in 50 years. So why would now it goes now at that price, unless there's a real catalyst, real like growth or anything like that. So on the more short term, what I like is kind of a downtrend in there, so you get narrow and narrow. So I got interested around here, and then after started kind of selling puts. So I'm not really in it like that I bought share, but I sold some put, which is the equivalent, but it's more like making a little income once it's under 11. And then like I was expecting still that it will continue to rise, but then it got really bad news and now back to there. So I don't know, I'm just continue selling lower price, but yeah, just saying like this is what I expect, that it could still drop or go up, but I think these prices are at least reasonable. Yeah, that's all I can say. Who knows, but still like a downside at the moment. As you can see, it kind of broke here, never really came back higher than that, and then now drop again. So you cannot really expect a uptrend either. Even though here it looked pretty good, it's still within that range here. So yeah, that's why we're still in downtrend on the short term. So this is catalyst. I mean, I could have looked way further and find some relationship with something, but I honestly couldn't really find one. All I could see is that whenever there were big crises, this stock tended to go down, but never really on the upside. So let's say if the world is kind of growing in the right way, it might go up, but then when there is a crisis, it goes down for sure. That's pretty much what I saw. So that's it. I will not share more on that. It's pretty much just like depending on how the world economy goes. So as a conclusion, I would say that the advantages are that it's a well-known brand, over 100 years old, like 130 nearly. And yeah, I mean, everyone knows about this brand. It was even on Formula One in the past, and everyone's seen it. It's an undervalued overall. The debt is high, but it's undervalued. So as you say, risk is a lot of debt to repay, right? So and the current Goodyear technical analysis price is quite low overall, as I showed you on the monthly. So that is where at least the downside is limited unless they lose control of their debt. And then so yeah, the good thing as well is download, so they're selling it to reduce the debt, which would reduce by 10% overall, which is not major, but would definitely impact, probably reduce somewhere around 50 million their debt interest. Then after the risk, so as I say, too much debt to repay, so that will take a while. The fundamental is not ideal, so even though it's undervalued, it's not very safe because of the debt again. And the technical analysis still on downtrend, sorry, misspelling. And yeah, but it's fairly low, at least compared to overall. But yeah, it's the downtrend is still there, and that's why it's a bit risky. So I would say still hard for this stock to really wait for uptrend, because it's rarely got one. Overall, I still want to say that it's not something I would really be so much interested in, but I'd love to see how much they manage the debt, and if they can reduce by 50% or more, it definitely would be a more long-term play. But right now it's not, so let's see what they do. Yeah, I hope you guys enjoyed the video, and see you in the next video.